Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day at 8 a.m. In this video, I am going to walk you through the process of valuing Transocean stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Transocean is a provider of offshore contract drilling services for oil and gas wells. It owns or has partial ownership in 45 mobile offshore drilling units. That includes 28 ultra-deepwater floaters, 14 harsh environment floaters, and 3 midwater floaters. The company has offices in 20 countries, including Canada and the United States. In 2010, Transocean was implicated in the Deepwater Horizon oil spill resulting from the explosion of one of its oil rigs in the Gulf of Mexico. Let's get started with the model. This is a small cap company, 1.5 billion market cap. They're trading at $2.52 a share, and they have 615 million shares outstanding. Let's look at the financials. The way you value a company is you forecast the future free cash flows, and then you discount that number back to today's value. That's what we're doing in this video. Free cash flow is cash flow from operations minus capital expenditures. You can see the company has positive free cash flow in 2 of the 4 years. Net income is the profit and loss on the income statement, revenue minus expenses, and they have negative net income every year. Revenue looks pretty good. It's growing each year little by little. This is the company's income statement. The top line is the revenue. Below that is the cost of revenue. And the difference between those two numbers is the gross profit. So it looks like they had the highest gross profit in the trailing 12 months, $2.5 billion. But they have really high operating expenses. They do have positive $158 million of operating income, but last year was negative. They had the highest operating income in 2017 at $600 million. But the company has a lot of debt, so their interest payments on their debt is more than their operating income. And the bottom line of the income statement is a net income, which is negative every single year. This is the statement of cash flows. And to calculate free cash flow, it's operating cash flow, which is on top, minus capital expenditures. They did have negative free cash flow in 2020 and 2019, but it wasn't a big negative. They had a pretty good amount of free cash flow in 2017 and 2018 though. The reason they had negative free cash flow is because they have a lot of CapEx, $346 million. CapEx are investments in property, plant, and equipment. Some of the equipment they use is pricey, and it doesn't appear that they're using capital stock to run their business. They did issue debt of $1 billion, $2 billion, $1 billion, and $700 million. But they did pay down more debt than they issued, which is good that they're lowering their debt load. Let's look at operating cash flow, because I think that's the most important part of the business. Net income can be a little confusing when looking at it because there's lots of non-cash items and accounting tricks going on. And the way you calculate operating cash flow, you start with net income. It was negative $584 million. But the company passed through a $1 billion depreciation expense on the income statement, which brings down their net income. But that's a non-cash item, because they actually paid for the products years ago. They're just passing through the expense now, because we have to add that billion back on the operating cash flow section. They also passed through $681 million of impairment expenses on the income statement, but that's a non-cash item, so we have to add it back on a statement of cash flows. Even though the company had negative net income, they operated with positive cash flow. Let's look at a capital structure. $12 billion of equity and $10 billion of debt, and they have $8 billion of net debt. They pay 6.26% interest on their debt, and cost of debt is 5.5%, and their cost of equity is 31%. To calculate cost of equity, we need the beta. That's how volatile the stock is relative to the market. And they have a really high beta, 3.73. So the stock moves almost 4 times the market. So it's a very volatile stock. And their WACC is 19%, which is a blend of the cost of debt and cost of equity. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4. That's $471 million. We discounted those numbers back to today using a weighted average cost of capital. We get a value of the company of $590 million. We divide that by 615 million shares. And we get a calculated stock price of 96 cents. They're trading at $2.52, so they're trading at a 163% premium. It's a sell according to the model. Simply Wall Street's valuation is 29 cents, so they're even lower than me. This is where the stock has been trading the past 5 years. So you can see it was trading above $15 at one point, but has come down quite a bit. It's at a really low point. In the past 52 weeks, the stock has decreased 58%. In that same time frame, the S&P 500 increased 15%. Its 52-week range is really wide, 65 cents up to $7.28. The stock is trading at 252, so it is trading above its 50-day moving average and its 200-day moving average. Of the 615 million shares outstanding, 580 million shares are available to the public. About half the shares are held by institutions. 21% of the shares on float are shorted. That's a really high short percentage, so investors are bearish on this stock. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $438 today. If you did not reinvest the dividends, you'd have $1,550 today. Transocean was formed with the merger of Southern Natural Gas and other smaller companies. In '96, the company acquired Norwegian group Transocean for $1.5 billion. In '99, the company merged with Sedco Forex, the off-drilling subsidiary of Schlumberger, for a $3.2 billion stock transaction. In 2000, the company acquired R&B Falcon, the owner of 115 drilling rigs, in a deal valued at $17.7 billion. In 2007, the company paid bribes to custom officials. Transocean admitted this and paid $13.4 million to settle the matter. In 2007, the company merged with Global Santa Fe, creating an enterprise value of $53 billion. In 2008, the company moved its headquarters to Switzerland to save money on taxes. In 2010, the company was implicated in the Deepwater Horizon oil spill when one of its rigs exploded in the Gulf of Mexico. In 2011, the company acquired Acre Drilling. In 2013, the company was added to the S&P 500 index. In 2018, the company acquired Songa Offshore. Then later that year, the company acquired Ocean Rig. Royal Dutch is the company's biggest customer, accounting for 26% of its revenue. Equinor accounts for 21%, and Chevron accounts for 17%. The company's top shareholders are PrimeCap, 8%, Vanguard, 7%, BlackRock, 6.5%, then Frederick Mohn, State Street, Van Eck, and Geode. The company stock is listed in the US, Switzerland, Mexico, Germany, Great Britain, and Sao Paulo, Brazil. The average age of its leadership team is 50 years, and the average tenure is 4.5 years. Its president has been with the company 5.5 years, and the compensation package is $10 million. Let's look at the financial ratios. The average PE in the market is 12.4, the median is 14.8. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so they have negative PE. Price to sales is stock price over sales per share. They're at 0.5, so they're doing much better than the median and average. Price to book is stock price over book value per share. They're only at 0.1, so they're doing much better than the median and average. And the way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities in the balance sheet, and their tangible equity is $11.3 billion, so they don't have much intangible assets on their balance sheet. Interest coverage ratio is EBIT over interest expense, so they cannot cover their interest payments with their EBIT. ROE is net income over equity, negative net income, negative ROE. Current ratio is current assets over current liabilities, so they can cover their current liabilities with their current assets. Their current assets are $1.8 billion of cash, $654 million of receivables, $500 million of inventory, and $550 million of restricted cash. Their free cash flow is negative $79 million and $1.9 billion of working capital. So it appears that the company is capitalized enough to get through the next year or two without needing more debt. This is the first company I did in the industry oil and gas drilling, so I can't compare them to anybody else. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking the link in the description below. Thanks for watching.